Hey, what's going on YouTube? We're going to go through Weight Watchers International, ticker symbol WW. We are going to go through some comps, look at the financials overall on Weight Watchers, and then figure out what Weight Watchers is valued at today. But currently we can see earnings per share are negative, but on Seeking Alpha here, we do have forward-looking positive earnings per share and a forward positive PE ratio, so we can plug those two into our calculator, which will help us figure out what this thing is potentially valued at. You know, when you're negative earnings, it's almost impossible to figure out what a company is actually worth in negative earnings territory. But year to date, this company is down 85.5%, and over the course of 1 year, down about 80%. And we also are sitting at about 21% short interest, and also sitting basically just pennies above our 52-week low range. They reported their Q1 earnings May 2nd, beat on their revenue, but missed significantly on their GAAP EPS by $3.84 and their normalized EPS by 59 cents. So significant misses on their EPS side. And then over here to upcoming quarters earnings, we have EPS revisions from analysts. 3 have revised those earnings lower in the future here. And we can come and see what we're kind of seeing and expecting for the next couple quarters coming up here. And it looks like the next 3 quarters, analysts are forecasting and expecting positive EPS, but right back into Q1 of 25 appears to be a significant decrease again in earnings. Could just be seasonal there. Otherwise, you know, we're looking at very minor growth overall in this business at the current time. So in their earnings report, there's a couple things I thought were worth mentioning here from their CEO. They expected to end the year with total subscribers in the range of 3.8 million to 4 million. And if we come up here, we can see their current subscribers is 4 million. So they're expecting 0 growth in subscribers and even potentially some negative growth on subscriber count. So it makes me hard to believe that analysts are going to be potentially correct on a positive EPS. Maybe there's something else beyond that I missed, but they're also including between 140,000 and 160,000 subscribers to their new Weight Watchers clinic, and currently they're sitting on about 91,000. So they're looking to add about maybe, you know, call it 50 to 60, maybe 70% growth there. So that's pretty decent growth. Obviously, when you're only talking 91,000 people going up to 160,000 people to have 60% growth, that's not really a big number, honestly. So if it was 91 million to 160 million, that's pretty significant. But also they said that they are transforming their business model for the future. That is not something you want to hear ever when you come and look at some of these earnings reports, that they're going to transform their business model for the future, like into something different, because they don't know what's going on. They don't know what to do. So definitely a little bit of a red flag as I read through that one anyway. So we're going to hop over to the valuation spreadsheet, look at the historical financials on Weight Watchers. We got revenue, gross profit, and net income on this chart here, and we can see just steady declines on all 3. Down to margins. Gross margins, though, are, continue to get better and better, which is, pretty good. But then you see those do not carry over to net margins. Net margins in the past have done looking like the high peak there was 14.8%. And then they just started going downhill pretty quickly. And now we're sitting here in last quarter, negative 168%. Trailing 12 months, negative 40% on net margins. So return on invested capital, though, still pretty good return on invested capital for this. It's kind of surprising. We got cash to short-term debts. Definitely not enough cash to cover our short-term debts, as we can see here. Cash to total debt, I mean, just, you put your cash into total debts, you didn't really do much. You didn't move the needle a whole lot there. Now over to free cash flows. Again, they've done pretty decent. I guess they've done positive free cash flows. And in the last, this 2023 and trailing 12 months there, have turned into negative free cash flows. Capital expenditures, pretty flat. So they're coming in a little bit, but for the most part, still, nothing really to complain about there, I don't think. Share count dilution, though, we are seeing consistent dilution. They were consistently flat, but then since 2023, they've probably needed to raise some capital to keep this business afloat. So they've issued more shares, and then if you are holding these shares, are getting diluted as they continue to issue more and more shares. So now we're going to look at their 10Q and see how finances are looking today on a quarterly basis, quarter over quarter comparison, year over year comparison as well on some of it. So quarter over quarter comparison, we're looking at our cash and cash equivalents here. We can see in December, we were sitting at about $109 million. Now we've almost cut that in half. We're down to $66 million left in cash. We come down here a little bit further. We've got franchise rights acquired. And they went from $386 million in franchise rights down to $128 million. This means that the value of the franchise rights have decreased significantly. So this isn't just they lost money. It's kind of like goodwill. If you acquire these franchising rights are now worth less, so they have to devalue what these franchise rights are currently valued, or what they're worth today now, because obviously the business is not growing, it's not getting better. So these franchising rights are no longer worth anything, or they're worth significantly less, as we can see here. So we went from 386 down to $128 million. And we can also see down here, total assets now got cut down by about 30%. So not ideal at all when you start to see your franchise rights, even sometimes your goodwill, when you start doing goodwill impairments, which is potentially what might be next as well. But we might also continue to see franchise rights get slashed in half even more yet going forward. So that is technically a non-cash expense. That is just valuations, and these valuations on franchising rights are not valued as what they were 3 months ago. As you can see, they're down by about $260 million, and maybe they got to do this every year, revalue what their franchising rights are actually currently, or what they are truly worth. So that's potentially what that could have been there. So down here to our overall liabilities, we do have some deferred revenues here of $36 million that we can eliminate from our cash, or from our total current liabilities. So if we do that, that puts us at about $213 million of short-term debt. And keep in mind, we only have $66 million in cash. So now we have a pretty significant negative cash position. And these $213 million of short-term debts need to get paid in a 12-month period. So they are going to probably need to raise more capital, because they're not positive free cash flows either. As we just saw in our valuation spreadsheet, they're turned negative into free cash flows. So they aren't generating more positive cash currently, unless they raise more capital, which is probably what they're going to end up needing to do. So overall, total debt is sitting at $1.73 billion with only $66 million in cash. That is very concerning. That is scary to think about. And down to our revenues, our income statement. We did slightly less subscription revenues year over year, and also other revenues. I think they're trimming off their low margin business, whatever that is. I don't exactly know, but they trimmed it down. Obviously, you can see, so their other revenues have been significantly decreased. So then the cost of other revenues, obviously, we can see here, this is a very low margin business, being that it's only about $3.4 million of actual profit that they made on that. So because they're eliminating that, our overall total revenues do get cut down quite a bit, but our overall profits, though, margin wise, are staying consistent, actually increasing a little bit because of that. So cost of revenues, though, down obviously, and our overall gross profit actually is up, which is pretty surprising. So our overall gross profit did increase year over year. Franchising rights impairment, we're going to take this as a loss, which is why we saw such a huge hit to our EPS. Obviously, I don't think analysts can really predict what the franchising rights impairments are going to be year over year like that. So that's why there was such a significant miss on EPS there. So that is going to be a non-cash charge to their income statement, and that'll get added back in over to their cash flows once we get to that. Overall interest expense on this company, because they have so much borrowed money, they're sitting at, they pay out quarterly $1.7 million in interest. So that's a big chunk of their overall gross profit. And then on top of it, they have all these other expenses, marketing, SG&A. You need to subtract out just these two from gross profit. You're not positive, and then you got more interest expense on top of it. So you're burning through cash, even just where you're currently sitting if you were to strip out these franchising rights. So overall, net loss sitting at $347.9 million. Again, a good chunk of that is from their franchising rights, but still you can do the math and see that there's still negative about $90 million there. And dilution for share count, we could see 70.6 up to 79.2 million shares outstanding. And then finally, to our cash flows, we got our net loss. We can see right here. Come down here, we got our impairments of franchising rights. These get added back in. And then our share base, our stock-based compensation, pretty flat, sitting at about $2.4 million. Then we come down here, overall cash used for operating activities, cash that flowed in and out of the business was negative $36 million. So $36 million flowed out of the business, not into the business. And so then we also have to subtract off $476,000, not million, $1,000 of capital expenditures. So this is actually about $36.5 million loss. I wrote this in wrong. So it's $36.5 million quarterly loss there. So we come down here to our cash. We see that our net decrease in cash and cash equivalents was $42.8 million of our $109 million, which leaves us with a $66.6 million cash position. So hypothetically, they have another quarter, next quarter, let's say, is going to be another negative quarter. They've got a quarter, maybe two left of cash before they need to find a way to raise more capital. And more than likely, that's only going to probably be from issuing more shares, maybe going to a bank, but more than likely issuing more shares, or they might just have to file for bankruptcy. So over to the comps, I pulled in two other companies to compare to, and we just scroll down here just to all of the numbers here, and we can see on each and every company has very identical like red flags here. And we got share change year over year, 12%, 82%, 9%, just, you know, all identical red flags across the board there. Come down here to our overall charts. Market cap on all three. And then we got a revenues, gross profit, and net income chart on all three as well. And we can just see no three of these companies is even churning any type of positive net incomes. And then down here, margins though, gross margins are fantastic. But then we come over here to operating margins. They just throw them right out the window. I mean, Weight Watchers is the best one, sitting at 8.4%, and their profit margin on all three are just obviously really bad. 40%, 118%, 27%, all negative. Free cash flows, nobody positive. Free cash flows. Overall, this is like a business just to probably stay away from, a little industry to stay away from overall. Obviously, we can see margins aren't great. Obviously, the stock chart kind of shows exactly that. There's zero investor interest in this business. So what we're gonna have to do here is plug in our forward-looking numbers here, assuming these are correct. I would take this with probably a grain of salt. I wouldn't get too excited about what's about to happen here. I haven't plugged these in yet, so I don't know. So we got 15 cents for a positive or forward-looking positive EPS. Our PE ratio is looking at 857. So we'll plug those two numbers in here. So if this happens, and we do have that happen, and in order for that to happen, we are going to have to see some pretty decent EPS growth flow into this business. And if it can do that, we're looking at P/E fair value of $10 per share. Multiples comparison, obviously our comparables are all negative, so we'll eliminate those from what we're doing. And then we come over here to price to book. We don't have that. We got a PEG ratio. This was the PEG ratio. This would be a forward-looking PEG sitting at 1.74. We've got grams valuation sitting at 1363. Our DCF valuation, they are currently negative free cash flow, so we're not even going to bother with including that. Rule 72, we've got, we're sitting at 15 cents. If we double a couple times, we can maybe get up to about a 1 for future EPS. And that gives us a fair value of about $17.15 per share. And then if we eliminate our DCF, because obviously negative, We're roughly looking at $13.59 per share, 30% margin safety, $9.51. Analysts have a price target of $6.92 per share. Now, again, this is one that I would just stay away from. Even though we did get some decent valuations out of it, the financials point towards bankruptcy. This is one, in my opinion, just to stay away from and just stay in the sidelines. As we come over here to the stock chart, we can see this thing is locked in a downtrend. This thing just keeps making new lows, and has recently also made another new low, sitting at $1.12 for its all-time lowest low it's ever had. And we can see this thing is very volatile. It has its moments where it does rip higher, and it still does it every now and again. And it might be due again for a potential short squeeze of some kind. May or may not happen. If it did happen, it could maybe get up to $28, $30 per share, but that would not be, this is not really investing in my opinion. This is just trying to play momentum trades. So this would be more of a day trader than anything. So this is kind of what we're looking at with Weight Watchers. Nothing very exciting. This is just something to, just to stay away from and let it bleed out. And maybe in the future, this thing does turn things around, and then we revisit the financials and see how things are going and see if it's actually looking like things are gonna look pretty decent for this one. And maybe it's a business worth investing into. But that is it, Weight Watchers. If you found value in this video, drop a like, subscribe, and comment. We'll be back a little later with another stock analysis video.